Welcome to Trading Nation. I'm Jackie DeAngelis, joined by Joe Zidle, portfolio strategist at Richard Bernstein Advisors. Joe, you're saying that there's a big surprise emerging this year, that it has to do with inflation. What are you observing in the market?
Thanks for having me on the program. I think inflation will be the big surprise, and I think we're beginning to see it in labor markets. Everybody's been looking at this unemployment rate coming down and down and down. We're now down about 4.4%, and yet wages have stayed relatively flat. I think last month wage gains were maybe in the 2% range on a year-over-year basis. But I think the big surprise is that with such tight labor markets, wages are going to be going higher. And one of the leading things that we're looking at, kind of one of the leading indicators to wages, is something by the Bureau of Labor Statistics called the involuntary versus voluntary separation ratio. And what that means in plain English is the number of people quitting relative to the number of people that are getting fired. And what this environment is showing us is that more and more people are quitting their jobs right now. And in the law of large numbers, the only reason why people quit their jobs in big numbers is because they have something better lined up and something that pays more. So I think the big surprise is going to be inflation that's starting with wages. And I think we're going to see it, I think, soon.
All right, tease that out for me. What comes next? If your thesis is correct, how does the Fed act on that? Because Janet Yellen is always talking about inflation.
Sure. It's got implications not only for the Fed, but also, for the stock market and for corporate profits. In corporate profits, what we find is, companies tend to like higher inflation, right? 3 to 4% inflation is a very good environment for profits. But as we know, the Fed tends to like lower inflation, say 2 to 3%. So I think it will create this tug of war, where if we actually see the wage price pressure and higher wages and inflation stemming from there, it's good for the consumer. Right? This economy is really based on consumption, so it puts more money in the hands of consumers. So I think that's going to be maybe the next accelerant or the next leg for this business and economic cycle. But at the same time, it could force the Fed's hand. The Fed historically tends to get behind the curve, and then the economy tends to grow faster than they're thinking, and then they tend to have to hike more aggressively than markets think they will. So if we do start to see this inflation, I think it's very good for cyclicals, right? Because they have pricing power. So your energy, materials, tech, financials, small companies, I think it's very, very good for them. But it could force the Fed to have to hike more aggressively than people think.
Okay, let's talk about the stock market in general. It just seems like it continues to go up, up, up on this perceived Trump rally. Why do you think folks feel like it's maybe moved a little bit too far, too fast, almost like they are expecting or want it to pull back?
Over the last year and a half, investors have gone from one macro risk to another, right? It was the election in France, and then before that, the election here in the U.S., then before that, Brexit, and before that, a hard landing in China and oil prices imploding. And meanwhile, beneath the surface, earnings have continued to reflate. They're getting better, and they're accelerating. So I think investors had been looking at the lower volatility over the course of the last couple weeks or couple months and thinking, oh, there needs to be a pullback. Something bad has to happen. But I think if you look at the data, if you step back and look at how investors are positioned, not necessarily their surveys, not how they're feeling, but how they vote with their wallets, what you find is investors continue to withdraw money from equities. So in other words, it's not a market price for perfection. Over the course of the last 12 months, where the S&P's gone up almost 17%, investors have withdrawn billions and billions of dollars from U.S. equity mutual funds and U.S. equity ETFs, and all that money is going to fixed income. So it really is an environment that is an unloved and under-owned bull market in our view.
So it's a little bit of a rotation is what you're saying. How much longer does that continue?
It's a good question. This is probably the 8th inning of this bull market, right? Clearly, the market is not valued as inexpensively as it was back in 2009. The economic expansion is certainly gone on now for 8+ years. So we wouldn't argue that this is early innings in this bull market. But in a late cycle environment, it's where you tend to see the inflation and the Fed hikes and the cyclical and commodity outperformance. And that's basically what's going on right now. So the 8th and 9th innings, they could certainly go on for a while. One thing's for sure, bull markets don't end with fear and skepticism, right? Typically, bull markets are ending with confidence or with euphoria. As we look at how investors are positioned, where they're still skeptical of this bull market, we think that it's still got a while to go. Earnings alone are going to continue to accelerate for probably the bulk of this year. which I think is going to drive equities and particularly those cyclicals higher and higher this year.
Well, final question. That seems to be the underlying picture taking us higher, the fundamentals when it comes to the stock market. It seems to be what's happening in Washington that's creating all of that volatility. Can you remember a time since you've been studying the market that we've been this tied to every move a president makes?
No, it really is a good question, an interesting question. And if there's a silver lining to all this, to the way that investors are seemingly like focused on Washington policy and palace intrigue and all this other stuff, if there's a silver lining to all of it, it has deflected people's attention away from the markets, so that the markets so that earnings and companies can continue to reflate. And frankly, it's been very good for the markets. But the flip side is it does have the potential to create a lot of volatility. It does have the potential to keep more investors on the sidelines. So I don't know if it's going to necessarily die out, but at some point investors might become more immune to the day-to-day volatility driven by the headlines.
All right, Joe Zidle of Richard Bernstein Advisors, thank you so much, and thank you for watching Trading Nation. We're going to see you next time.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.